Welcome to the TBI Trading Channel. And in today's video, we're going to be talking about something called liquidity. So today, I'm going to be changing the candlestick colors just to get you guys used to different type of colors of the candlestick. You understand? Because the color doesn't really mean, because I've noticed something about traders. They end up using the same color as their mentors, which is not really that compulsory. You can use any color that you want. In the last video I used black and white. The previous one I used that's my default color, that's black and gold. So in today's video I'm going to be using green. I don't really like the green. Let me change it to something like blue. I actually prefer blue. I don't know why I prefer blue too. So you guys can just look at how to change. I just double clicked on the chart. Yeah, I think this is actually way better. I don't know, but it kind of looks better to me. So in today's video, we're going to be looking at something called sorry, liquidity. Now, what is liquidity? And in economics, liquidity is actually like what sorry about that. It's actually what moves the market. It is what moves the market. So and now, for you to determine where liquidity is, it means you are trying to determine where market is going to most likely move. You see this kind of huge down candle right here. There's something that occurred, something happened before this huge down candle can occur. Like even if it's probably a news that pushed this candle to the downside, like this, there's still something that have occurred. There's still a certain amount of liquidity that has entered the market that pushed price down to this level. So now, for you to now identify liquidity, now the next thing we're going to be looking at now is how to identify liquidity. So let's get an text this, how to identify liquidity, which is usually most times you see most people denoting it as X. So how to identify liquidity? So you can identify liquidity in different areas of the market, and that's we have previous highs, or let's say old highs. Okay, let's say old highs and lows. Swing highs and lows. They're almost the same thing, but there's a little bit different between old highs and swing highs and lows. I'm going to explain to you very soon. Swing highs and lows. Then we have equal highs, equal highs, and equal lows. Equal highs and lows. Then I think that is where you can mostly get liquidity from. Now, some of you that are a little bit familiar with SMC or smart money concept or ICT, whatever you guys call it, maybe like, oh, he's already teaching us ICT concepts. Yes, kind of. Now I told you earlier that this strategy is a combination of ICT and SMC and basic price action concepts. So now, how do we use liquidity? Well, let's talk about how to identify it first. The first one we talked about was old highs and old lows. Now, for you to identify an old high is an high that has occurred in a very long time. I don't know. Let's say price has been in a downtrend for a very long time. Price is still in a downtrend. I think you guys should already understand how to get your structures now. Then price, then boom, broke structure. It's now coming back up, price is coming back up. I don't know if you've noticed something around this place. This is what we call an old high. An high that price has not tested in a very long time. If you look at this high, price has tested it. If you look at this high, price has tested it. If you look at this high, price has recently tested it. But what high has price not tested in a very long time? This high, this is an old high. Why swing highs and swing low? Why an old low? This is going to be an old low. That is, if price moves up, where is this? Yeah, if price maybe forms an uptrend and price keep going, then boom, price retraced, because when an uptrend comes turns to a downtrend, it's called a change of character, and the term is called retracement. So and this uptrend retraced to become this downtrend, it's going to be aiming for this old low here, which is liquidity. I'm going to explain to you very soon why price um searches for liquidity and what happens most times when price gets to liquidity. So we're talking about old highs and old lows. This is now, if you look at this, this is going to be the current old high. Don't forget about that. So now swing highs and swing lows, like we've talked in the last we've talked about it in the last video. So these are swing. This is swing high, swing low, swing high, swing low. Is a swing high, is a swing low. Is a this did this break? I think it broke it, but let's say it didn't break it. Let's put this down. Let's pull this down in order to, yeah, so there won't be any confusion. This is not a swing high, but this is a swing high. This is swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low, and the likes. I'm not going to go I'm not going to go into labeling this because we've already talked about that in the previous video. But if you don't really understand, just let us know in the comment section, and we're going to make another video to make you guys understand it better. So now the next thing we're going to look at is equal highs and equal lows. So equal highs and equal lows, we don't really have any example of equal highs and equal lows here, but we can easily draw that. So okay, and delete. So imagine we have something like this, price coming down like this, then now in the market, this is what we call an equal high. Two highs that are um almost the same, that are almost that very very close to each other, as you can see. Not only two eyes, series of eyes that are very very close to each other. This is also an equal eye. This is and you can call this an equal low. You can kind of call this an equal low. Let me draw it a little bit closer. An equal low, yeah. So and the likes and the like. So liquidity is usually around these areas. Now that we've learned how to identify liquidity, now we're going to talk about why, like what happens when price gets to liquidity. So before we jump into that, let's jump into the actual chart to try to identify liquidity in this chart. Don't forget, the blue candle is the bullish candle and the red candle is the bearish candle. So the first thing we said was old highs and old lows, old highs and old lows. Now if we look at, okay, let me put this right here. Before price, we already know that price broke this high. But before price broke this high, what can we call? If we zoom out, I'm zooming out. Where is the oldest high in this chart right now? This is the oldest high in this chart. So this is liquidity. On top, you can just write something like X. You can just write, sorry about that. You can just write X. X. Yep. This is where you can find liquidity here. Now, where is the lowest low? As far as this chart is concerned, from here down to this place, this is the lowest low. So here, I think this is the lowest. This is the swing low right here. I know you guys should already understand swing lows. This is a swing low. So this is going to be the old low, and we can also bring another X. We can bring another X down to this place. So this is a swing low. So we can find liquidity in this high, this old high, and in this old low. And don't forget, we can also find liquidity we are in swing highs and swing lows. So you can find liquidity in this swing high, you can find it in this swing low, this swing high, this swing low, this swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing high, and the likes, and the likes, and the likes, and the likes. So you can find liquidity in those areas. So you can tag them XXX. And one of the most important, you can also find liquidity in equal highs and equal lows. Okay, I'm not done with you yet. Boom. So we can find liquidity in equal highs and equal lows. Now, if you look at this chart very, very carefully, you find out that from here, from here to this place is an equal high, or let's say relatively equal highs. From here to the whole of this place, they are relatively equal highs. Um, here to here equal highs. Here to here equal highs to this to the top of this week here. Here to the top of this equal highs. If you look at it here, from here to here equal highs. They don't have to be exactly equal, but they just have to be relative. That is almost equal. It still counts. Equal highs. You can even call this equal highs if you want. They are almost equal. What else? We have equal highs right here. If we zoom in, we see that these are equal highs. From here to here, equal highs to, yeah, this is a very nice one too. Here to here, equal highs. Here, this is also an equal highs. They are very close to each other. Or you can just call this an equal high from here to here to make it simple. Equal highs, and you can also call this equal highs from here to here, like that, like that, like that. So for you, you guys should just open your chart to try to get the equal highs and equal lows. Yeah, sorry about that. So now we've already known how to identify equal highs and how to identify liquidity from old highs and old lows, swing highs, swing lows, equal highs, equal lows. So we now want to talk about why do we identify liquidity. So why do we identify liquidity? Now, first of all, I don't think there's need to write any of this. The reason why we identify liquidity is because this is the major difference between basic price action trading and smart money concept, that is trading like the banks. So retail traders, that is basic price action traders, they tend to believe that when you see price giving you equal lows, equal highs, they tend to believe that it's, for instance, if I draw, let me draw a straight line, right? Let me draw an horizontal line right here. Sorry. Retail traders, that is basic price action traders, tend to believe that when you see something like this, you see the price tested this the first time, came back, came to test the second time, it means that this zone is strong, and it means that price will most likely not come back. As you can see, price came one, two, and came down. It means that this zone is very, very strong. But smart money traders believe that when price tests a zone multiple times, or gives you equal highs or equal lows, or in every swing high and swing low, there is tendency that a lot of people are placing trades around that area. And it means that a lot of people will enter this trade, will sell this pair, this AUD USD around this area, which means that their stop loss is going to be somewhere above this area. So a lot of people are going to sell here, which means their stop loss is going to be above this. So smart money concept traders, many of them believe that every area where you can identify liquidity is an area where a lot of stop loss is above. Now, if you read the book, we are going to explain what stop loss means. Stop loss is just a zone you set where you have made up your mind to lose a certain amount of money if your prediction is wrong. For instance, if I predicted that um if I predicted that this is going to sell from here to this zone, for instance, if according to my prediction, price is going to sell from here to this zone, from here to this zone. So if price gets to this zone, I probably make $10. And I already told myself that okay, if price doesn't get to this zone, I'm ready to risk $2. As you can see, price didn't get to this zone, then boom, it hit my stop loss. So this stop loss is what most um smart money concept is trying to target, because liquidity can only push a market when there is liquidity is just the amount of money that's inside a market that will push it to a particular direction, and price cannot get you can't get that amount of money without stopping some people out of the market. So a lot of people are going to eat their stop loss for market to move in a particular direction. So back to the question, why do we identify liquidity? We identify liquidity because those are areas we expect price to run through to hit people's stop loss. For instance, look at this area there. Look at this liquidity, this equal eyes right here. Because this is a liquidity, I'll be expecting price to run through this area. For come back to this. This is a double tops. This is sorry equal highs. They have relatively the same highs here and here. And what the price came back to run is high, stopping out people that have entered their trade around here. So anybody that has placed a trade around here is going to end up losing their money. And it is those loss that is going to fuel this movement down. So some of you might be like, wow, what about this equal highs? What about this equal highs? What about this equal highs? Yes, price is still going to come back later on. Probably not now. Price is still going to come back later on to clear this highs, because there's this tendency that a lot of people still have their stop loss above these highs. So let's look for examples. Let's try to identify some liquidity and show you where price has cleared them. So for instance, look at this. This is equal lows. You can see this set of equal lows. You can see this set of equal lows. You can easily identify where liquidity is when you see a lot of wicks. When you see a lot of wicks spiking down in a particular place, you can also see liquidity is around that area. So this set of equal lows, you can say they're relative. They're just playing around the same lows, very very close to one another. What the price? The price went up, came down. A lot of people are going to place their trade around here. A lot of people are going to place their trades around here. Probably here. They'll be like, oh my god, I had a sniper entry. Put their stop loss right here, and they'll try to target reasonable trades, like you target from here down to this zone right here. Then boom, this is what happened. Now some of you might be like, why didn't I get out here? Why didn't I? First of all, you actually don't know where. You actually don't know exactly where the market is going to reverse until it reverses. Number one, number two, I might be looking on to swing this trade, that is holding a very long distance trade for like a week or two. So as you can see, this equal lows price ended up coming back to clear this equal lows. That is, price came to clear this liquidity. And if you see what happened exactly after price cleared those liquidity, you see price moved. It is the money gotten from the millions of traders after price cleared this liquidity that fueled this upward movement. That is what fueled um this upward movement, and you can see what happened next. Price ended up buying seriously to that zone. So there might be some times that you might have a very, I don't know if you've placed a trade, or you probably still place a trade in the future, or you find out that your analysis was actually very right, but price came to eat your stop loss before going into profit. That's because your stop loss is already at a level of liquidity. So now, how do we like use this liquidity to our own advantage? So we are going to look at that in the next video. We're going to talking about the two major types of liquidity. Yeah, I think I told you how where to identify liquidities, that is and the swing high, swing lows, and the right and the likes and the likes. But those are not the two major types of liquidity. So we're going to look at the two major types of liquidity in the next video. So I'm just trying to make these videos a little bit shorter than the previous ones are, so that you guys, it will be easy for you to rewatch it over and over and over. We'll see you guys in the next video.